Thank you again for joining me on another video session. Today, I'm going to go over a topic that surprisingly baffles many people. Okay, it either baffles people because most people misunderstand what the purpose of that particular order or trade is, or they've never been educated or instructed on how to place that kind of an order properly. Okay, now I'm going to take the mystery away and say this video is about how do you place an effective stop loss order. Okay, and I know that topic has been discussed many times. There have been books written about it, or in a particular trading book, a chapter or two dedicated to it. And I know many people talk about it in different ways. But here, I want to cover some very important points about stop losses, why they should be used, what are the most common errors when it comes to placing stop losses that I've seen and that I've also gone through in my life. What's the most effective way to place a stop loss? What do you do when a stop loss gets hit? How do you go through that cycle, both emotionally and mathematically? And then finally, how do you manage your stop once you have an effective stop on it? Okay, so I'm going to cover this. The video might be a little longer than usual, but I'm still going to try to cover it in kind of like a short series. Okay, and here, this is how it goes. First, what is a stop loss order? A stop loss is an order that you place that after you enter a trade, meaning, like, let's say you buy a particular stock, or you buy or go long a particular futures contract, or let's say you short a market, because you can place stops on shorts as well. A short is when you think the price of a market is about to come down, and then you want to speculate in that direction. So what you'll say is, I want to short this market or sell that market, and therefore you can place a stop to buy that contract back. I mean, I'm going to deal with that complication a little later, but understand that you can place stops both in a long trade, which means you're buying into a market and you're expecting the price to go higher. And you can also place stops in a short trade, which means you expect the market to move lower and you would profit if the market would come down. Okay. Now, what is a stop loss? A stop loss, in my opinion, is a trade that you place that if the premise of why you got into that trade has been nullified, then you want to be out of that market. Do you understand that? Now, let me say that very clearly, okay? Let's say you think the price of crude oil is moving higher from this day. Like, after you observe the market, you think the price of crude oil is going to move higher because of reason number one, reason number two, and reason number three, which should be mathematical reasons combined with some price action analysis, right? Once you've made that analysis, then you decide to place the trade thinking that the price of crude oil is going to move higher. Now, what you should do is, at the same time, you should have decided and calculated a stop loss order or a stop loss price that if the price of crude oil were to move against your thinking, or were to move down in this particular example, and if it goes below that particular price, then you want to be out of the market. Very, very important. This is why I sum it up by saying a stop loss is an order that you place that if the market nullifies the premise of why you got into that market in the first place, if the market were to, or the price action were to nullify the premise of why you got into that market, then you want to be out of that market. You should be happy that you got kicked out, because the longer you stay in it, the more money you're going to lose. Okay, so that's what a stop loss is. It's a way to protect you that if, after all of your calculations and after all of your analysis, if the market were to go against what you thought it would do, or go against your directional analysis, and when it nullifies the premise of why you got into it, then you're out. Okay, now here's another important thing that I want to say. Never, ever place a trade, an entry trade into a market without a stop loss. And I know there are some people who might be like, oh, I've heard this before. I always place a stop and then my stop gets hit. Or I try my best to analyze and figure out where I want to put the stop. And as soon as I put my stop, the market seems to go know where it is and go hit it. I don't care what the experience has been, okay? It is unimaginable to me that you would put a particular trade on, or you would decide to put a certain amount of money at risk and then say that if the analysis is incorrect, or if the price action goes against what you thought it was going to do, that you're going to continue to hold that trade if the price action nullifies the premise of why you got into it. That doesn't make any sense to me. Do you understand that? Because for you to be trading for a significant period of time, not just trading for 1 week or 1 month and be done with it, but if you want to significantly be trading and making money over a long period of time, you have to say to yourself that when you're wrong, it's okay to be wrong, number one. And when the premise of why you got into a market has been nullified, you have to be out of it. That's what a stop does. So this is my rule. Never place a trade without a stop loss, an entry trade. And here's the other thing, and this is something I read a long time ago, and we always kind of knew it while we were practicing it because it was kind of natural for us, right? That is, decide on your stop loss, on the stop loss price before you enter the trade, because all objectivity is gone completely once you place your trade. Once you're in a trade, then don't decide, if the market comes here or if the market goes there, then I'm going to place a stop here. All that's nonsense, because all objectivity is gone once you place the trade. And because of that, always decide on your stop loss before you place the trade, okay? Now, here's the next thing. What are the common errors that I've seen that people make when it comes to placing stop losses? Here's the first error, right? Now, I guest lecture at UCLA Extension on commodities trading and alternative investing. And I hear this a lot from the students there. They say, well, I place a stop loss because I don't want to lose more than this much money on a particular trade. And then another student will tell me, well, I place a stop loss at this point because I don't want the market to go past this percentage of my monetary value or account value. And I hear all these amazing reasons that are just being shouted out at me, right? And I go, wow, this is very strange. It's almost like we think we control the market and we choose how to put the stop loss. That doesn't make any sense to me, because first, let me tell you something. The market does not care about your pain level when it comes to how much money you are okay losing and you're not okay losing, okay? Because the market doesn't care about that. Like, for example, if you feel like if you lose more than $5,000,
Content is for educational purposes only. This is not investment advice from Bullionite LLC. There is always risk for substantial losses in investing and or trading through any financial instrument with or without this or any other type of advertised product. Past performances are not indicative of future results. Different types of investments involve varying degrees of risk. Specific strategies or education presented by Bullionite LLC and its associates in this video are